Working capital. Working capital is money that's available to a company for its day-to-day operations. Simply put, working capital indicates a company's operating liquidity and efficiency. A company's working capital reflects a host of company activities, including cash, inventory, accounts receivable, accounts payable, and the portion of debt due within 1 year, as well as any other short-term accounts. This can extend to inventory management, debt management, revenue collection, and payments to suppliers. Working capital represents a company's ability to pay its current liabilities with its current assets. Working capital is an important measure of financial health since creditors can measure a company's ability to pay off its debts within a year. Working capital also represents the difference between a firm's current assets and current liabilities. The challenge can be determining the proper category for the vast array of assets and liabilities on a corporate balance sheet and deciphering the overall health of a firm in meeting its short-term commitments. Working capital can be calculated by determining the current assets and the current liabilities of a company. Current assets include the company's liquid cash as well as other assets that can be converted to cash within 1 year or less. Some examples of current assets include money in checking accounts, inventory, supplies, equipment, and temporary investments. Current liabilities include all the expenses and debts that a company needs to pay within 1 year. Examples of current liabilities are accounts payable, dividends, and income tax owed. While working capital funds do not expire, the working capital figure does change over time. That's because a company's current liabilities and current assets are based on a rolling 12-month period. The exact working capital figure can change every day, depending on the nature of a company's debt. What was once a long-term liability, such as a 10-year loan, becomes a current liability in the 9th year when the repayment deadline is less than a year away. Similarly, what was once a long-term asset, such as real estate or equipment, suddenly becomes a current asset when a buyer is lined up. Working capital as current assets cannot be depreciated the way long-term, fixed assets are. Certain working capital, such as inventory and accounts receivable, may lose value or even be written off sometimes, but how that is recorded does not follow depreciation rules. Working capital as current assets can only be expensed immediately as one-time costs to match the revenue they help generate in the period. While it can't lose its value to depreciation over time, working capital may be devalued when some assets have to be marked to market. That happens when an asset's price is below its original cost, and others are not salvageable. Two common examples involve inventory and accounts receivable. Inventory obsolescence can be a real issue in operations. When that happens, the market for the inventory has priced it lower than the inventory's initial purchase value as recorded in the accounting books. To reflect current market conditions and use the lower of cost in market method, a company marks the inventory down, resulting in a loss of value in working capital. Some accounts receivable may become uncollectible at some point and have to be totally written off, which is another loss of value in working capital. As such losses in current assets reduce working capital below its desired level, it may take longer-term funds or assets to replenish the current asset shortfall, a costly way to finance additional working capital. Positive working capital generally indicates whether a company is able to quickly pay off its short-term liabilities. Negative working capital generally indicates that a company is unable to do so. This is why analysts are sensitive to decreases in working capital and may suggest that a company is becoming over-leveraged, struggling to maintain/grow sales, paying bills too quickly, or collecting receivables too slowly. Increases in working capital, on the other hand, suggest the opposite. The working capital formula, current assets, current liabilities, demonstrates that if a company has positive working capital, it will be able to repay its payables and other short-term debt, even if business were to suddenly dry up. Companies with positive working capital may face a problem if they have only enough cash to pay for day-to-day operations and not enough cash for further expenses. The most common factors that can positively and negatively impact a company's working capital are listed below. Credit policy. If a company tightens its credit policy, outstanding accounts receivables will shrink since customers are required to pay more quickly. This will increase the amount of cash the company is bringing in. However, customers may buy less as a result. Conversely, If a company grants customers more time to pay, cash will come in more slowly, but customers may be encouraged to buy more goods on credit. Inventory planning. In anticipation of sales growth, a company may increase its inventory levels. Increasing inventory will use cash, and shrinking inventory will free up cash. Purchasing. In an effort to reduce unit costs, a company may reduce its costs by purchasing materials in greater volumes. While the initial outlay may be attributed more to larger volume, more cash would be available over the long term due to cost savings. Accounts payable. A company may decide to change the way it pays vendors. Switching from 30-day net, where bills are paid monthly, to a 45-day net policy to free up cash.